This is David Coster with the Mortgage News Network, reporting from the Mortgage Bankers Association 100th Annual Convention. I'm joined today by Andrew Liput. Andrew is the CEO of Secure Settlements. Andrew, thank you for being here.
Thank you, David.
Tell me a little bit about your company and what it is that you offer to the mortgage community.
Well, Secure Settlements is what we call a data intelligence and risk analytics firm. In the last number of years, there's been a greater emphasis on risk management within the mortgage industry, both to protect lenders from losses from bad loans, from fraudulent loans, but also to create a better environment for consumers and to make sure consumers are protected throughout the mortgage process. Many of the risk management functions are required to be outsourced because banks' primary functions are selling loans, not really doing risk management, and so many of them feel comfortable with hiring a firm like ours who specializes in that. All we do 24/7 is risk management.
Well, you're also an attorney.
Yes.
Did you expect when you were in law school that this is what you'd be doing at this point in your life?
Not at all. But I'll tell you how I got there. It's an interesting story because I was an attorney in the banking industry and actually had been what they call a settlement agent. I closed loans on behalf of lenders. And probably about 10 years ago, I noticed what I thought was a gap in risk management as it surrounds the closing table. The mortgage industry had developed great tools for addressing fraud and potential risk in origination of loans, in the processing and underwriting of loans. But at that closing table where they wire the money and they send the documents, which is such an important function, not only within the industry, but because that's the place where the consumer actually closes the deal. In the single largest financial transaction of their lives, there seemed to be not enough risk management in place. And so about a decade ago, I started trying to think of ways to help correct what I thought was an imbalance in that area. And I started meeting with people, developing ideas, which eventually led to the creation of Secure Settlements.
Outstanding. Well, I read on your website that 13% perhaps of all financial fraud is related to settlements. That seems like an incredible number and something that we obviously need to be very concerned about.
Yeah, I'm going to just correct you. It's actually 15%.
15%.
And the reason that we want to be careful about the number, or I want to focus on it, is because for many years, the industry never really parsed fraud data so that people could understand how much of fraud was directly related to escrow and closing and what happens at the closing table. It was only, I think, in about 2011 that the FBI, who keeps most of these fraud figures, started reporting them and breaking it out. And so what they discovered is that 15% of overall mortgage fraud was directly related to escrow and settlement. Last year, there were about $13 billion in fraud claims. So if you apply that 15% number, you're looking at close to $2 billion in claims directly related to this problem.
Is it a problem that's getting worse? Is it a problem that's gotten better? Was it something that was involved in the pre-crash days, or is it something that is continuing?
That's an excellent question, and I think the amount of fraud that takes place has some direct correlation between the type of business that's being done. We've just come out of a 3-year period where there's been a lot of refi business, what they call rate and term refis, where people simply are refinancing a loan to get a lower rate. There's very little fraud in that type of business. You see the majority of fraud when there are transactions taking place. So for the past 3 years, we've had a little bit of a lull in mortgage fraud. The numbers started coming down. But as we all know, that refi business has dropped off. And just recently, in about July or August, it just fell off the end of a table. And now we're back to what we call a purchase market. That purchase market is much riskier. And so I think we're seeing a situation where we're going to get into riskier business again. And so the industry is trying to get poised and to develop the processes so they don't get back to where we were when the market collapsed.
And how are you finding the receptiveness of the lenders and the wholesale, retail, correspondent channels?
Well, I think overall it's good. They get the idea. The nature of the mortgage business, though, is it's a sales-driven business. So anytime you bring a solution to the table that doesn't necessarily affect the bottom line positively, at least in the short term, there's always a little skepticism about spending money and focusing on that. But I think people are starting to recognize, not the least because regulators are now requiring it, that they have to do more in this area. And so we're finding that people are receptive. They're very interested in outsourcing it so that they can focus on selling loans and they can leave us to shoulder the burden of helping them meet their regulatory requirements.
Excellent. I want to wrap up with two questions that are related to something I read on your website, which I found very interesting. In your statement of philosophy and values, and I apologize for reading it, but I want to get it correct. You say never trust public data 100%. Why should we not trust it 100%?
Well, because today anyone can post something on the internet, and even the best public data aggregators can get it wrong. So one of the things we pride ourselves are we don't just look at information and regurgitate it back. What we do is when we look at someone, we analyze a company or an individual for risk. If we find any derogatory data, we stop the process and we interact with them. We give them the opportunity to show us that what we found might be wrong. We also do something different in that we go to multiple sources, because sometimes if you just go to one source, you can get burned. By going to multiple sources, we have that sort of cross-reference. So between the multiple sources, interacting directly with those who we're vetting and conducting vendor management, risk management with, it gives us a greater comfort level. A, we're being fair and ethical in what we do, and B, that we're delivering a result that people can rely on.
Great. And finally, you make this statement: people fear change. We are bringing change. Remember, and be kind.
Yeah, we try to impart upon all of our employees that what we're doing is really a paradigm shift within the industry. We're part of a paradigm shift. We're bringing risk management into areas where there was no risk management before. And so when we go to somebody and we say, look, we want to vet you, we want to conduct a background search on you, there can be an understandable negative reaction to that, or a fear. Well, why are they looking at me? What are they going to find? How's it going to affect my business? So we just make it clear to our people, and when we do business with folks, that we're not against you, we're for you. And we think that by helping to show show people your background and show people that you are professional, it's going to elevate you, not hurt you. And at the end of the day, it's only the bad actors who have something to worry about, and they should be out of the industry anyway.
Outstanding.
So
that's great. Well, thank you very much. I appreciate your time today.
Thank you, David.
You have a great show.